Hi everyone, welcome back to Web3 Daily. In the past 24 hours, the crypto market has been sluggish. Bitcoin is stuck around 118K, briefly dipped to 116K, but quickly bounced back, signaling that support is still intact, though there's not much bullish momentum to push higher. Ethereum is a little stronger, holding above 3.8K, but it also lacks conviction. Hot coins like SOL, LDO, ARB all floated with the tide, minor ups and downs. BNB held steady but didn't deliver any surprises either. Overall, the market is clearly in wait-and-see mode. The recent Fed decision didn't give any solid rate cut hints, and institutions are hesitant to make the first move. No one wants to be the first to jump in or get caught on the wrong side. We're in that frustrating zone, not quite a bull market, but not breaking down either. Stablecoin inflows are slowing, and long-short ratios are dead, even in the derivatives market. Nobody's going all in, and nobody's panic selling. On the technicals, daily RSI and MACD are converging, classic signs of a market waiting for news. A quick risk reminder here, this is prime fake breakout territory. If you're trading, don't get baited by short-term moves. These are the conditions where people get chopped up. Best move? Stay light, stay patient, and wait for confirmation. The hottest topic in crypto right now? Robinhood's wild move to launch an OpenAI token. Yeah, they literally branded it as a way for retail to share in OpenAI's growth. Sounds fancy, until OpenAI jumped in and said, "We never issued any token, cue chaos." X blew up. Some called it a FOMO gimmick, others called it real-world meme coin innovation. Musk even chimed in, mocking the whole thing with a brutal "your equity is fake." You know it's serious when Elon's roasting you. Still, some folks are buying in not because they think it's legit equity, but because they want to be part of the story. It's pure belief-based investing. No fundamentals, no rights, just vibes. Kinda like meme coins, but with a corporate twist. Is it a scam? Maybe not. But it's definitely narrative finance at work, people buying into a story, not a balance sheet. That's powerful, but also dangerous if you don't know what you're doing. And let's be real, regulators aren't going to stay quiet. This isn't a harmless joke if it's seen as misleading or posing as a security. Robinhood's gonna have some serious explaining to do. My take? It's a clever gray area hustle, but like all experiments in mass belief, it only works if the crowd keeps clapping. Once that stops, well, you don't want to be the last one holding the token. Let's get into the first big headline today. The Fed held interest rates steady, but internal cracks are showing, and Trump's putting pressure on. That's a cocktail for short-term market turbulence. So here's what happened. The Fed left rates unchanged, no surprise, but two Trump-appointed members voted against that, pushing for immediate rate cuts. That's rare, and it signals political pressure creeping in. At the same time, Trump's been out here saying if Powell doesn't cut soon, he might be replaced. Real subtle, right? Powell played it safe in the press conference. He said inflation's trending lower, but it's not enough to justify a rate cut yet. He dodged questions on whether they'd cut in September and straight up avoided any talk of reappointment. The guy's walking a tightrope between the data and the politics. Markets didn't like the uncertainty. Bitcoin dipped hard to 116K, ETH followed, and we saw a mini wave of liquidations, mostly over-leveraged longs. But dip buyers stepped in quick, and prices stabilized. So we're looking at a classic news shock pattern, no trend reversal, just chop. Big picture, this kind of political noise might actually strengthen Bitcoin's long-term appeal. When the traditional system looks shaky, hard assets gain credibility. But short-term? Volatility is going to be wild. Policy flip-flops are dangerous. Watch your positioning. Long-term bullish, but trade carefully. Second headline. The White House just dropped a massive report on crypto regulation, 166 pages deep. Some are calling it the blueprint for crypto's future in the US, while others think it's just the same old talk in a new wrapper. Here's the gist. The Trump administration is getting serious about bringing crypto into the system, but under strict terms. It's not about letting Bitcoin run wild, it's about creating a controlled, dollar-aligned crypto structure. The report outlines reforms in 5 major areas: market structure, DeFi, banking participation, stablecoins, and crypto taxation. Key suggestions include giving the CFTC authority over non-security assets like Bitcoin, letting banks legally offer custody and stablecoin services, establishing Sandbox programs for DeFi, and pushing the so-called Genius Act to anchor crypto innovation to US dollar dominance. It also proposes banning a Fed-backed CBDC to protect individual privacy. That's a clear political shot. Now, none of this is law yet. These are recommendations they need Congress to act. So while it sounds good on paper, nothing's changing tomorrow. But the message is clear. The US isn't trying to kill crypto anymore. It wants to own and regulate it, shape it into a tool that serves American financial power, not challenge it. This is about creating a safe, centralized version of innovation, or as they put it, paving the road for a golden era. Still, many in the industry rolled their eyes. One analyst said, "It's everything we've already heard except for the part we care about most." Yeah, the report says nothing about whether the US will buy Bitcoin as a reserve asset. When asked, officials said that announcement is coming soon. We'll see. My take? This report sets the tone, but what really matters is what they do next. Will Congress follow through? Will we see actual rule changes? And most importantly, will the US government put Bitcoin on its balance sheet? Until we get those answers, it's just noise. Headline 3 is from Europe. Deutsche Bank, Galaxy, and Flow Traders just teamed up to launch a fully regulated Euro stablecoin called EURAU. It's already live on Ethereum. Now, this might not sound flashy, but it's a huge signal. Why? Because for years, the stablecoin space has been dominated by the dollar, USDT, USDC, you name it. Euro-backed stablecoins? Practically non-existent, making up less than 0.2% of the market. That's a sovereignty issue for the EU. EURAU changes that. It's one euro-backed, approved by Germany's BaFin regulator and compliant with the EU's MiCA framework. First exchange listing? Bullish Europe, a regulated platform under German oversight. The issuer is a new firm called AllUnity, backed by Deutsche Bank's asset arm DWS, crypto-native Galaxy, and trading giant Flow Traders. It's classic TradFi meets crypto. EURAU launched as an ERC20 token and plans to go multi-chain. Big names like BitGo and Fireblocks are handling custody and security. This isn't just another stablecoin, it's Europe's move in the global digital currency chess game. The US has been exporting dollar dominance via stablecoins. Now the EU wants in, pushing EURAU as a strategic alternative. Will it work? Depends on regulation, adoption, and trust. But the fact that a fully compliant Euro stablecoin exists and has real institutional firepower behind it is a major milestone. To me, this marks a shift. Stablecoins are entering the era of geopolitical alignment. It's no longer about who builds the best tech, it's about who has the strongest regulatory backing. EURAU is the EU's first major play. News number 4 comes from Hong Kong. The Monetary Authority just rolled out a new stablecoin regulation framework with a 6-month grace period. Don't sleep on this. It's one of the most detailed, actionable, and aggressive regulatory rollouts for stablecoins in Asia. Here's what's happening. Starting August honest, all stablecoin issuers operating in Hong Kong are pegged to fiat like HKD must apply for a license. They get 6 months to comply. If you submit a plan within 3 months and meet all conditions in 6, you're good. Otherwise, it's game over, shut it down. The rules are tight. 100% liquid asset backing, T+1 redemption, local presence, full KYC, on-chain risk monitoring, and full anti-money laundering compliance. And yes, they're working on legislation to ban unlicensed marketing and promotion of stablecoins. Why is Hong Kong doing this? Because they see stablecoins as the backbone of Web3 finance. While the US, EU, and Japan are still debating frameworks, Hong Kong is moving fast, locking down a regulatory lead in Asia. Major players like JD.com and Ant Group are already setting up companies to apply for licenses. Even Standard Chartered is running a pilot for HKD stablecoins. This isn't just about regulation, it's about becoming the base layer of the next financial wave. Market reaction? Mostly positive. Projects finally have a rulebook. Some firms are even considering relocating HQs to Hong Kong. Of course, smaller players might get squeezed out, it's a high bar. But that's kind of the point. Filter out the weak, reward the serious. My take? This is Hong Kong planting a flag. It's the first real move in Asia's stablecoin power play. Singapore, Korea, UAE, they're all lining up. But Hong Kong just stepped on the gas. If the HKD stablecoin ecosystem takes off, Hong Kong's crypto finance game goes next level. Headline 5 comes out of India. Top exchange CoinDCX got hacked for 44 million and now it looks like an insider might be involved. Oh, and rumor has it, Coinbase might be eyeing an acquisition. Here's what we know. CoinDCX, one of India's largest licensed crypto exchanges, was hacked in mid-July. Details were murky at first, but police now say a company engineer's laptop was used in the attack. The guy's been arrested, and the investigation is still unfolding. Initial findings suggest a classic social engineering play. Attackers likely gained remote access to the engineer's device, grabbed back-end credentials, and siphoned off the funds. The employee admits to doing outside contract work, but denies involvement in the hack. This is a big deal for India's crypto scene. CoinDCX isn't some sketchy offshore shop, it's part of the government's Sandbox program. If they can get hit this hard, people are going to start questioning what compliant actually means in terms of security. And here's the kicker. Word is Coinbase might buy them out for up to $1 billion. If that happens, it could be Coinbase's backdoor into India, a notoriously tricky but massively valuable market. Why does this matter? Because this wasn't a code exploit, it was an insider vector, and that's becoming more common. We're seeing a shift in hacker tactics. Forget breaking smart contracts, just go after the weakest human link. It's faster, and often easier. If the Coinbase deal goes through, it'd be a big win for them. If not, CoinDCX still has to rebuild trust and fast. Either way, this is a wake-up call. You can't just build for compliance anymore. You need airtight internal security. And that starts with every single employee endpoint. Headline 6 is a wild one. MicroStrategy just launched a new financial product, a 9.5% yield priority stock backed entirely by their Bitcoin holdings. Yeah, you heard that right. Bitcoin is now funding retirements. Let's back up. MicroStrategy's Q2 earnings just dropped, And they're up big. 10 billion in profits thanks to BTC going vertical. They now hold 628,800 BTC, worth nearly 74 billion. That makes them the largest corporate whale in the game. Now they've taken it a step further. This new product ticker, STRCs, a no maturity date, monthly yielding preferred stock that pays 9.5% annually, fully collateralized by Bitcoin. Saylor says even if BTC crashes 80%, they can still cover 24 years of interest payments, and it's already trading on NASDAQ. Why does this matter? Because this is the first time we've seen corporate-held Bitcoin turn into a tradable, yield-generating product for traditional finance. It's Bitcoin, but wrapped in a suit and tie. It's perfect for risk-averse capital pension funds, insurers, family offices folks who'd never touch BTC directly, but will gladly take 9.5% yield on something backed by it. And with secondary market liquidity, they're not locked in. Of course, there are risks. If BTC tanks 90% and liquidity dries up, STRC might face pressure. But the bigger picture, this is Bitcoin going full Wall Street. It's being financialized, packaged, and monetized like any other asset class. Love him or hate him, Saylor knows what he's doing. He's not just hoarding BTC anymore, he's turning it into a revenue stream, a way to monetize conviction without selling a single coin. This might just be the model for crypto-native balance sheets in the future. That's it for today's Web3 Daily. If you're tracking these market moves and narratives, make sure to follow or save this episode. We'll be back soon with more fresh signals from the front lines of crypto. In a world where trends flip fast and stories drive price, staying sharp means staying ahead. Catch you next time.